In this short video tutorial, I hope to explain the principles of statements of financial position, i.e. balance sheets, and I hope to explain this in under 10 minutes. The statement of financial position, i.e. the balance sheet, is a statement of the assets, liabilities and capital of a business at a particular date. The statement of financial position is based on a formula called the accounting equation, which states that assets equals to capital and liabilities. This equation must always balance, so assets must always be the same, equals to capital and liabilities. Assets are the resources used by a business. In effect, assets are what the business owns. Examples of assets would include office furniture, computers, cash, accounts receivable, etc. Assets are classified under two headings. 1. Non-current assets. Non-current assets are assets which represent a longer-term investment and cannot be converted into cash quickly. They are likely to be held by a company for more than a year. Examples of non-current assets include land, property, machinery, and equipment. Non-current assets are not bought with the intention of resale. In other words, they are bought with the intention of keeping in the business and using them. Current assets represent all the assets of a company that are expected to be sold, consumed, used, or exhausted through standard business operations within 1 year. Current assets include cash and bank, inventory, stock, accounts receivable, debtors, prepaid expenses, etc. Liabilities consist of monies owed by the business. This can include loans, or monies owed for goods supplied, or monies owed for expenses. Liabilities are classified under two headings. 1. Non-current liabilities. Non-current liabilities are obligations of the company which are expected to get paid after a period of 1 year, and examples of non-current liabilities would include long-term loans, long-term lease obligations, bonds, or sometimes referred to as debentures, and other non-current liabilities. Current liabilities, these are obligations of the company which are expected to get paid within the period of 1 year. So the difference really is long-term liabilities are going to be paid beyond a year, beyond 12 months, while current liabilities will be paid within the next 12 months. Current liabilities include liabilities such as accounts payable, creditors, short-term loans, interest payable, bank overdrafts. A bank overdraft is effectively a form of short-term loan, and other short-term liabilities of the company. Capital. Capital is what the owner or owners invest in the business, whether in the form of cash or other assets such as motor vehicles, premises, expertise. In its simplest form, capital means the funds brought into the business by the owner or owners of a company. It is an investment by the proprietors or partners in the business. Capital is also called net worth, or sometimes referred to as owner's equity. Bringing in equity, capital, can mean money or assets as well. The statement of financial position, i.e. the balance sheet, is a statement of the assets, the liabilities, and the capital of a business at a particular date. The statement of financial position shows what the business owns, the assets, and owes, the liabilities and capital, at one point in time, usually the end of the financial year. So, at the top of a statement of financial position, you would probably see something like this. Statement of financial position as at day, month, year. So if the financial year end was the 31st of December 2019, this statement would read, Statement of Financial Position as at 31st of 12th, 2019. Let us now look at an example. So the following information has been extracted from the books of Mr. Green, a shop owner, for the year ended 31st of December. So Mr. Green has assets, and there they are there. Shop fittings, 68,000. Delivery van, 24,000. Computer, 7,000. Accounts receivable, 24,000. And bank, 20,000. Mr. Green also has liabilities. Accounts payable, 20,000. Accounts payable being the creditors. And long-term loan, 50,000. And then he also has his capital, owner's capital, 80,000. Now we're also provided here with some additional information. The net profit coming from the income statement, 23,000. The closing inventory, 20,000. And drawings. Drawings represents money which Mr. Green took out of the business for his own personal use, and they come to 10,000. So we're going to put this into a balance sheet, and we're going to start off with the assets. Remember, in a balance sheet, or statement of financial position, assets must equal capital and liabilities. Now we're going to have two columns over here. Nothing to do with debit or credit. It's for presentation purposes. And what I'm going to do is I'm going to start off here listing my non-current assets. Non-current assets are the assets that Mr. Green bought and keeps and uses in the business year in, year out. And they would be shop fittings, delivery van, and the computer. So from the previous slide, we can see we're going to write in the value of those amounts here. And they were 68,000 for the shop fittings, 24,000 for the delivery van, and 7,000 for the computer. Now I'm going to add those up and bring the total out to the right-hand column, and they come to 99,000. So therefore the total of the non-current assets comes to 99,000. Next, back over here, I'm going to list the current assets. And the current assets will be the closing inventory. Remember, it's the inventory at the end of the year, so the 31st of December. It's the accounts receivable, the debtors, and the bank. Now again, from the previous page, we can see the closing inventory was 20,000. That was under the additional information. The accounts receivable was 24,000, and the bank was 20,000. So I'm going to add those up and bring the total out to the right-hand column, line it up underneath the total figure for the non-current assets. So that's 64,000. So now I have my 99,000 of non-current assets plus 64,000 for the current assets. And if I add those two together, I'm going to get my total assets. So I'll add the whole thing up over here, and it comes to 163,000. So total assets come to 163,000. And remember, this represents the assets that Mr. Green owns on the 31st of December. Now, finally, we're going to look at the capital and the liabilities. First of all, I'm going to list my capital. I've got my opening capital plus the net profit. Profit increases the wealth of the owner. It increases capital. And then I'm going to take away from that the money that Mr. Green took out of the business, the drawings. Again, I'm going to list those in this column here and bring the total out to the right-hand column. And when I have that done, I'll have the closing capital being the total. So 80,000 opening capital plus the net profit, 23,000, less the drawings of 10, and then the closing capital, bring it out here to the right-hand column, 93,000. Now I'll put in my non-current liabilities. Now I've only one non-current liability, that's the long-term loan, so I'm going to bring that straight out to the right-hand column, 50,000. And then finally I have my current liabilities. Again, I've only one, so I'm going to bring that straight out here to the right-hand column, 20,000. And then if I add these three numbers together, I will get the total capital and liabilities, which comes to 163,000. 163,000 is the total of the capital and liabilities, and I would just jump back here to look at the assets. Total assets 163,000. So total assets equals to total liabilities. Thank you for listening, and I hope you found this short video tutorial beneficial.